Today we're going to go over Chapter 11, Lending Practices. In Chapter 9 we talked about the two components that make up a mortgage. And so this slide is sort of a reminder of that. So we know that a mortgage is typically a large loan that a buyer is going to use whenever they're purchasing a property. And there's two separate documents associated with it. The first one is the promissory note. This is all of the details associated with the lender and the borrower's relationship. So how much is your interest rate, when are your payments due, how long is the mortgage, all of that. The mortgage itself is a separate document that you sign at closing, and this is the document that actually pledges the property as security for the debt. So this is the document that actually creates a lien. These are a couple of mortgage loan terms. Whenever you go and you're trying to get a mortgage on your house, you can actually lock in a specific interest rate. This is called a loan commitment. So this is where your lender is going to say, okay, you can get this loan for 3.25% and we're going to lock it in today, and that's going to be good for usually anywhere from 30 to 45 days. After the 45-day period, you can continue to keep that same locked-in rate, but there's going to be penalties if you're actually closing on the house past the time frame that they originally gave you. So kind of keep that in mind. Mortgage payments are divided into two basic parts. You have the principal and you have the interest. The principal is the amount that you're borrowing for the house. So if you're borrowing $150,000, that is your principal. That is the amount that you are going to have to pay back over the term of the loan. The interest is what the bank is charging you in order to get the loan to begin with. So you have a portion of your mortgage payment that is going to go towards principal, and you have a portion that goes towards interest every month. In the House of Cards documentary that you watched, they talked a lot about ARM loans, adjustable rate mortgages. There's lots of different types of mortgages that you can get. You can have a fixed rate mortgage or you can have an adjustable rate mortgage. An adjustable rate mortgage is one where the interest that is charged is actually flexible. It can change, it can go up, it can go down, it usually goes up. That's the bad part. Because when your interest rate goes up, your payment goes up. It's hard to budget when you don't know exactly what your payment's going to be. So adjustable rate mortgages I would be very cautious about. Fixed rate mortgages, on the other hand, are a specific amount is quoted to you, say 4.5%, and you will pay that over the term of the loan. Even if you pay every single payment, 360 payments for 30 years, the rate is not going to change. If they quoted you 4%, that's what you're going to pay over the life of that mortgage. Here we have different types of loans. So the first one that they have listed is a term loan. Term loans are where you pay nothing but interest payments only until the loan balance is due in full, and then you pay the entire balance. So a term loan is where you're just making interest payments, and then at the end of the term you pay the interest that's due at that point as well as the principal balance that you originally borrowed. When you have an amortized loan, on the other hand, you're paying a payment that is going to include principal as well as interest. The principal and the interest amounts vary, but usually with a fully amortized loan, your payment amount is exactly the same. You're just paying a portion towards principal and a portion towards interest. At the end of the loan term, you're going to have the whole thing paid in full. A balloon loan is where your final payment is larger than any of the other payments that you've previously made. So a term loan would be an example of a balloon loan as well. So you're making payments, maybe you're making more than interest payments, but the very last payment that you make is going to be bigger than any of the others, so it balloons, it gets bigger. You can also have a partially amortized loan where maybe you're only amortizing a portion of the mortgage, maybe you're amortizing half of it, and then at the end of, say, a 15 or a 20-year period, you pay the remaining balance in full. So it's partially amortized, and then it has a balloon payment when it's mature. This slide is showing you how the different types of loans can actually result in total payment differences. So if you look at the first term loan here, we have a 6-year loan. It's a $1,000 loan at 9% interest, which is insane, but for the sake of example. So what you're doing with a term loan is you're just making interest payments for 5 years, and then the 6th year you're going to pay interest as well as the full principal amount. So in total, over the 6-year time frame, you're going to pay $1,540, so $1,540. If you amortize that loan, on the other hand, Your payments are a little bit more every single year, but by the time you make all 6 payments, the total amount that you've paid towards the loan is only $1,337.52. So you actually pay less over the term of the mortgage or the loan in this example. The next couple of slides that are popping up are not going to have any audio because they're just variations of this example. How many of you have a budget? Everyone raise their hand, because if you don't have one, you need one, and you're going to need to create one. So a budget mortgage actually makes it a lot easier for you to budget. And the reason for that is because not only do you have a principal and an interest amount that you have to pay every month with your mortgage, but there's other expenses that are associated with owning a house. For instance, you have taxes and you have insurance, which you just can't get away from. You have to pay property taxes. That's the highest priority lien on your property. And if you have a mortgage, then you have to have insurance. So why not pay a little bit towards your taxes and a little bit towards your insurance every single month, as opposed to paying the taxes at the end of the year when they're due and paying the full insurance amount at the anniversary of the purchase of the property? So a budget mortgage actually collects 1/12 of your taxable amount, and it collects 1/12 of your insurance. And so you are paying a little bit of your taxes, a little bit of your insurance, along with your principal and your interest every single month. So it helps you to more easily budget exactly the amounts that are coming out of your paycheck every single month. The next slide is going to show you an example of this. So this is how the budget mortgage works. You have a PITI payment. The PITI is principal, interest, taxes, and insurance. So 1/12 of your taxes are collected, 1/12 of your insurance is collected, and then whenever those bills are due, your mortgage company actually pays them for you. So you don't have to worry about a large expense at the end of the year or at the anniversary of the purchase of your property. So definitely a good way to go. Loan to value is a term that lenders use when they're talking about how much you're actually borrowing versus what the market value of the house is. So how much would the house sell for versus how much are you borrowing on the mortgage. So you have a market value of $100,000. The loan is $80,000. So what is the loan to value ratio? 80%. In the House of Cards documentary, it was all about equity. Equity is the difference between what you could sell your house for, what is the market value today, versus how much you still owe on the property. So if the market values of properties are increasing significantly, then you are going to see a rise in the equity that you have in the house. Another term that's listed here, we have discount points and then we have points. Discount points is a way that lenders can actually charge a borrower to basically reduce the interest that they have the interest rate that they've quoted you. So if you want to pay a lower interest rate, you can pay discount points to the lender up front and they will lower the rate that you're charged. Now here's the thing about it. The points are 1% of the loan amount, so they're very expensive. And most of the time, if you've been quoted a higher interest rate anyway, you probably don't have a whole lot of cash to be paying down discount points. So in my 14 years of selling real estate, I've never seen anyone buy them, although it is an option. Origination fee. The lender is going to charge you a fee for making the loan to you. So they call it an origination fee. It's typically a percentage of the loan amount. I see anywhere from 1% to 1.5% to 2%. I think the most I've ever seen is 2.5%. So we're going to talk a little bit about different types of mortgages. The first one here is a conventional mortgage loan. This is the oldest form of mortgage that you can get. It's predominantly level payment. It's a fixed rate. So it's fully amortized loan. You make the same payment every single month, and at the end of the loan term, you've paid everything in full, including the principal and the interest. Now, this is a standard home loan, which means it's not insured by FHA or VA. It's not guaranteed by VA. You'll understand that in a minute. Now, conventional mortgage loans were revolutionized in the 1940s, right after the Great Depression, because they created something called private mortgage insurance. Prior to private mortgage insurance, lenders were afraid to loan too much money because they were afraid if someone defaulted, they wouldn't be able to sell the property to get their money back. Well, private mortgage insurance sort of changed all of that. So we're going to talk about how that works. So with conventional mortgage loans, you have something called PMI. This is private mortgage insurance. This protects the lender against losses due to default. So generally, if you are not putting down at least 20% on your mortgage, you're going to have to pay private mortgage insurance. So it's required for loans over 80% of value. So there's two different ways that you can pay PMI. You can pay it in a single upfront premium, which is 2.5% of the loan amount, or you can pay it annually, which they break down into monthly payments. It's added to your PITI. So those are your two options. It's either or. Most people choose the annual premium option and they go with that, okay? Here's one of the good things about private mortgage insurance. It's not the type of insurance that you have to have forever. So if your loan falls below 80% of current value, you can actually call your lender and say, I think I'm at 80%, will you terminate my PMI? They'll have an appraiser come out to verify that you're at 80%, and likely they will terminate it. Now, if you don't know to do that, and a lot of people don't, when your loan falls to 78% of original value, the lender is required to remove your private mortgage insurance. I remember the day that I got a letter in the mail that said your private mortgage insurance is being terminated, and it saved me like $36 and change every single month. So that's kind of exciting, right? So your private mortgage insurance is one of those things that it's required if you're not putting down 20%, but it doesn't last forever. Here's a private mortgage insurance example so you can see what I'm talking about. So we have a house here, you're paying $100,000 for it, you're putting down a little bit, so your loan amount's $95,000. Now, here's the thing about private mortgage insurance. It's based on the loan amount, not the price that you actually pay for the house. So private mortgage insurance will insure the top 20% of $95,000. So that's going to be the first $19,000 in loss. So let's just say that you're the one who bought this house and you've paid down this loan to $94,000, but now you're in default. So you go to foreclosure and the house sells at foreclosure for $90,000. Well, the loss is only going to be $4,000 because you've paid it down to 94, it's sold for 90, so $4,000 is the only loss that the lender is going to see. Now, with private mortgage insurance, they're completely covered because the lender is covered with a loss up to $19,000. So PMI covers all of that. The second type of mortgage that we're going to talk about, this is an FHA mortgage. This is Federal Housing Administration. So this was created in 1934 in response to the Great Depression, and they were trying to stimulate the economy. They were trying to stimulate the industry. They wanted to protect lenders, but they wanted people to still buy and borrow money. So the FHA is a part of the Department of Housing and Urban Development. This is HUD, and they make FHA loans through approved private lending institutions. So FHA provides the lender with insurance. So just like with a conventional mortgage where you have PMI, FHA also has insurance attached to it, but it's called something different. Now, FHA will insure 100% of your loan. A lot of people really like FHA mortgages, and the reason for that is because the down payment is small. You only have to put down 3.5% as a down payment. The other thing that's really cool about an FHA mortgage is the fact that the money that you put down as a down payment can actually be gifted money. So it can be a gift. You could have a rich uncle that decides to give you some money, grandma, your parents. I've had a lot of students who have purchased houses from me, and they're students. Their parents co-sign, they get an FHA loan so that the down payment can be a gift, and then the entire time that they're in school, all 4, sometimes 5 years, they're building their credit. So an FHA mortgage is one of those that a lot of people really like, but it does have insurance attached to it. With a conventional mortgage, you have PMI, which is private mortgage insurance. With an FHA mortgage, you have MIP, just to confuse you, right? So with MIP, there's an upfront premium that you have to pay of 1.5%. This can be included in your loan, so you can roll this into your loan amount. You also then have to pay an annual premium as well. Okay, so it depends on how you want to do that, whether you want to do it for a mortgage that's 15 years or something that's less. It's going to be less if it's for a longer term. Now, with PMI and a conventional mortgage, you get to choose how you're going to pay your insurance. With MIP, you have to pay it up front and you have to pay it annually. So there's no option there. The other thing that is a negative about MIP is it never goes away. So as long as you have this loan, you will always have to pay MIP. The last type of loan that we're going to talk about here is Veterans Affairs. So this is a VA mortgage, and this is for qualified veterans or widows or widowers of veterans. So what they do at the VA is they guarantee loans. So they will guarantee certain percentages depending on how much you're actually borrowing. They will make a loan up to 100% of value. There is a funding fee that is associated with a VA loan. And if you look at the very bottom of the slide, it says funding fee can be added to the loan, but the closing cost cannot. That's actually incorrect. I had a military guy in one of my classes about 2 semesters ago, and he said you actually can now include the closing cost in the loan. So you can roll the funding fee as well as the closing cost into it. The next couple of slides here just show you examples of some of the ways that you can compare a VA and an FHA mortgage. And so take a look at the next few slides. You also have some topics that you should know by the end of this chapter, and that will wrap up chapter 11.